Master of Business Administration MBA, Financial Management 2, Cost of Capital and wacc. In the previous video, we focused on looking at DuPont analysis and the different components of the DuPont identity. And then we looked a little bit at the ratios, a couple of debt ratios. What we're going to do in this video is we're going to build on that. And we're going to look specifically at what's the cost of debt, what's the cost of equity, and how to combine those to find what the average cost is. So the wacc actually stands for Weighted Average Cost of Capital. And we'll have a look and see how that is done. And here's a diagram that you should be very familiar with by now. And we're just looking at the balance sheet, and the focus is going to be on the right hand side of this balance sheet, which is the source of funds. And our source of funds is your long-term debt and your equity. And this is how the company chooses to fund the business. And when we talk about the cost of capital, we're looking at what is the cost of our debt and what is the cost of our equity. And generally people who look at this, because there's an exact cost for debt, they see that as being more expensive than equity, because equity is just a share of the profits. So what we're going to be focusing on really is, what is the cost of this? What is the cost of your debt? And we're going to look at what the cost is, and then what is the true cost of debt. And then we're also going to focus on what is the cost of equity. The fact that they share in their profit, some people feel like it's almost like free money, and it definitely isn't. In fact, the cost of equity is more than the cost of debt. And we'll examine that later on during the video. So let's have a look at the cost of debt. What is it? It's the return that lenders require on the firm's debt. The cost of debt is simply the interest rate the firm must pay on funds it borrows. Now the thing is that it's not borrowing money at one rate and only once. It can borrow a whole lot of different times, and so you need to get the portfolio weight of that debt. And you can see by this diagram over here, the repo rate is the rate at which the banks lend to the banks, and then the prime rate is the rate that you and I or companies would borrow at. And often, depending on the strength of your balance sheet, the strength of your relationship, you would get a rate of prime plus something or prime minus something, but it would be based on the prime rate, and that would be the cost of debt. But there's another thing we're going to add to it later on that affects the cost of debt and actually makes it a little bit cheaper. What's the cost of equity? Because a lot of people think and feel like the cost of equity, well, there's no real cost, it's just if we make profits. But there is a big cost for equity, and the cost is a return that investors require on their investment in the firm. And the cost is actually more because people are taking a risk and they want to be compensated for that risk. And it's something that we cannot observe directly. It's got to be estimated, and there are two ways of estimating it. There's one method which is called the dividend growth model, and the other one called the capital asset pricing model, the CAPM. And we use these two methods primarily to determine what the cost is. It's a cost that we can observe rather than we know exactly what that is. And just to observe that in a sense is if we look at the all share index returns in South Africa for the last 40 years. You can see this interesting graph, and it just actually shows how the returns on the stock market do go up and down, and there have been periods of big drops. And in 2020 we've actually hitting a drop at the moment with the whole situation with the COVID. But there have been financial crises before where we've had similar drops of 40+%. As you can see, in 89 there was the Black Monday, there was the Asian crisis in the year 2000. We had our own little South African interest rate crisis. In 2008, the financial crisis. And then we had the stagnation years for about 5 years, and unfortunately leading into another drop. But even with all these crises, if you have a look over this period of time, the compound annual growth rate, if you took your money and you invested in the market, would be around 18%. And this includes the dividend. And so somebody who invests in a company will use this as a benchmark and would want to factor this in, that the returns need to be related to this compound annual growth rate where they could have invested in the all share index. And that's part of the thinking that we'll take you through. So let's go and look at the dividend growth model approach first of all. We have a look at this, and what it is, it looks at the returns that the investor will get and the price of the share, and this is the formula that one could look at. I am not, for the purposes of this course, going to go into this formula. There are quite a few problems with the dividend growth model, and we're not going to unpack it in too much detail, just that you know that it exists, but it's not for our purposes, because the main flaws are that not all companies pay dividends, not all companies that do pay dividends continue paying dividends, and not all dividend paying companies increase their dividend payment. And these are the key factors that are required in order to use this approach. But it's important you know that there is an approach like this, but the CAPM is the one that we will focus on. So as I mentioned, the advantage of this is it's relatively easy to understand. This is the growth model. But basically that's the only real advantage. It's got other bigger disadvantages. It's only applicable to companies that are currently paying dividends. It's only not applicable if companies aren't growing at a constant rate, which in my opinion is a little bit disconcerting. And it's extremely sensitive to your estimates on growth, because whatever you determine the growth is will affect that cost quite massively. So the disadvantages, in my opinion, outweigh the ease of use massively. And it doesn't take into account the risk. And so we will focus on the capital asset pricing model, CAPM. If you go to any business school around the world and you learn finance, this will definitely be covered. Before we get into it, I have to tell you that the problem with this is that it's also based on estimates. It can vary quite a bit based on what your input data is and what the estimates you use. But unfortunately, we have no better way of estimating what the cost of equity is. So this is the best we can have. And if you had to search Google and go and have a look at the drawbacks of the CAPM model, you'll find lots of research telling you about the drawbacks. But we do not have a better approach at this stage. So this is what we use to estimate it. So you start off with your risk-free rate. We're saying that investors that are investing in companies, people who are putting equity into the business, they want to receive at least the risk-free rate. And what is the risk-free rate? That's a rate you would get if you're taking no risk, generally related to government bonds. Whatever the rate would be on a government bond in any particular country, that would generally be what we term the risk-free rate. Then you look at the market return rate, and that's what we looked at on the previous graph of what would the market give you as a return. Now, the part that the market gives you as a return, less that risk-free rate, that's what's called the market premium. So if the market was giving you 18% and your risk-free rate was 7%, then that difference, the 11, would be the market risk premium, just as a way of an example. And the other factor that we need to take into account with a capital asset pricing model is the beta. And the beta is what we call the systematic risk of an asset. And that means it's the specific risk of that company. There is a formula that you can go through and a way of calculating what the beta of every company is. We're not going to include that as part of this course, but just know there is a formula to calculate the beta of each company, or you can go to some research companies that will calculate the beta for you. But you need to know what the beta is in order to plug it into this formula. A beta of 1 means that your riskiness of your company that you're looking at is the average, is equal to the average of the whole market. So a company that has a beta of 1 has the average risk of the market. A company with a beta of 0.8 is less risky than the rest of the market, and a company, for example, of 1.6 is more risky than the average market. You would take these components and you plug it into this formula. And what this formula says is your cost of equity is equal to your risk-free rate plus the beta multiplied by the market premium. And that premium is made up of your market rate return minus that risk-free rate. So this portion over here, your market return minus your risk-free rate, is what we call the market premium. And so all you need to do when you're calculating this is the cost of equity is your risk-free rate plus the beta, the riskiness of that specific company, multiplied by the market premium. And let's do a little example with this. So there's that formula and the components, and let's say a share of a company, let's call it ABC, has a beta of 1.88. The expected return on the market is 17%, and the risk-free rate is 9%. Please calculate the expected return by shareholders on this share. And so this would be the way you would calculate the equity. I think if I could ask you to stop your video now, try and do this calculation, and then come back. Welcome back. I hope you've done this calculation, and let's see if we get the same answer. So your risk-free rate equals 9%. The market premium would be that 17 minus 9, which should give you the 8%. The beta is 1.88, and if you plug that all into that formula, you should have got that your cost of equity in this particular case would have been 24.04%. What are the advantages and disadvantages of the capital asset pricing model? So the advantages is it explicitly adjusts for systematic risk. In other words, it adjusts for the risk of that specific company. It's applicable to all companies. They don't have to only be paying dividend or not, or any subset like that. The only provisor is that you're able to calculate the beta for that company. The disadvantages is that we have to estimate the expected market risk premium, and this could vary over time. And even now, when I showed you that previous graph and I said that your average compound annual growth rate was 18%, in the last while that might not be the 18%, and maybe we don't want to use the 18% because the market has drastically shifted. Maybe you have to estimate the beta, which also varies over time. The riskiness of a company is very different, or could be very different, one year to the next. This is applicable to the times that we are in right now with the whole COVID situation, where riskiness of companies is massively different. There are companies that are at risk now that were never at risk before. And we're relying on the past to predict the future. Not always the best thing to do. It is great to look back to see what happened so we can try and estimate what is going to happen. But the future, as they said, is not what it used to be. In other words, the future is not the past. You can't drive forward by looking in your rearview mirror. You can see where you came from, which might give some prediction to the future, but it's not a guarantee. So when we look at your average cost of capital, so we've got debt and we've got equity, and we want to get the average. So let me walk you through this. If the cost of debt is 10% and the cost of equity is 18%, what is your average cost of capital? I'm pausing here so that you can have a look at this. And I know that some of you are going to say, well, this is easy. And you might be tempted to say, we'll take the 10% plus the 18%, which gives us 28%. We'll divide it by 2 and we get your average cost of capital is 14. But that is wrong. And you might say, but why? It's wrong because it depends on how much debt and how much equity we need. So we need to take the weightings into account. If I buy something for 1 rand and I buy another 2 things for 10 rand, I can't just take 10 plus 1 and divide by 2. I've got to take the fact that I bought 2 of the 10. And so this is where the weightings come into account. And so if I give you this detail and I say, well, we got debt of 200,000, equity of 600,000, the total capital is 800,000. And so you can see then obviously that the proportion of debt is 25% and the proportion of equity is 75%. You would then take this and apply it to what you've got previously. And you might be tempted to say, well, we're going to take the debt of 25% multiplied by its cost, which we've been given, which is 10%. And then you take your equity, 75%, and multiply it by the 18%. You get its proportion, and you'd add those 2 proportions up, and now you get the average cost of 16%. Can you see the words? You may be tempted, because this too is wrong. And now you're thinking, like, what else do I need to add to this? What else do you think that we haven't taken into account? And what we haven't taken into account is the tax. And we need to calculate the true cost of debt. And we take the cost of debt is its cost minus the tax rate. And this we call the tax shield. We have to take into account the tax shield when we do this calculation. And let me explain to you how this comes about. When you're earning some money and you get to your profit before interest and tax, and then you pay tax. And let's just say tax is 30%. And so if our earnings are 100, we're paying 30% of that. If we had debt, our expenses would be higher because the interest we pay is pre-tax money. Remember, you got profit before interest and tax, and then you take your interest away and then you pay tax. So you're paying tax after you've paid interest. So there's a saving. If I pay interest, I pay less tax. And we've got to take that portion into account, and that's what we call the tax shield. So if I now take what we've learned here, and I take this and we plug it into the formula, the weighted average cost of capital formula. You have the formula, and if you read it in any textbook, you would see this formula. And this formula talks about the way you calculate your weighted average cost of capital is you have all these components, and then you take the proportion of equity to the value of the whole company and you multiply that by the cost of equity, and then you take the portion of debt, you multiply it by the cost of debt, and then you take the tax shield into account. And this is very interesting, but there's an easier way of doing it. We're going to do exactly what this formula does, in my opinion, in a very much easier way. And here's the wacc, the 4-step approach. This is all you need to do, 4 steps. Number 1, you need to find the true cost of debt. That's the cost of debt after taking the tax shield into account. You need to find the proportion of debt to total capital and the proportion of equity to total capital. Then you will multiply those costs by the proportion, and you just add those up and you have your wacc. Let's go through an example. So if I said to you, what's the average cost of capital for this company? And you have the cost of debt is 10%, the cost of equity is 18%. What is your weighted average cost of capital? And it gives you a tax rate of 28%, and it tells you we have debt of 6 million and equity of 3 million. So the first step that we had to do was to find the true cost of debt. The cost of debt is 10%. but we need to take that tax shield into account, so we multiply it by 1 minus the tax rate, and this will land up to be 7.2%. So the true cost of debt is 7.2%. The second step was find the proportion of debt and proportion of equity. And so your debt is 6 million out of a total of 9, which is 66.67%. Your equity is the remaining 3, which is 33.33%. Step number 3, multiply the cost by the proportion. So we take the cost, 7.2 for debt, and we multiply that by the 66.67%. We take the cost of equity, which is 18%, which in this case was given to us, but we might have been given the components and had to calculate it, but in this case it was given. And we multiply that by the 33.33%, and you would get its portion. And then you add those two up, the 4.8 and the 6, and we land up with a WACC, with a weighted average cost of capital in this case of 10.8%. And obviously that's your cost. You need to ensure that the company is getting a return of greater than 10.8%. Here's just an illustration of really what we're doing. So your cost of debt is looking at what's your average cost for all your debt. That's a whole separate calculation. We multiply that by the tax shield to get the cost of debt, and then we multiply that by the proportion of its debt. In terms of the cost of equity, we need to know what the beta is, the riskiness of that specific company. We need to know what the risk premium is. In other words, what is the general market earning over and above the risk-free rate, and we need to know what that risk-free rate is. And if we multiply that out, we'll get the cost of equity, but then we need to multiply that by its proportion, and when we add the top half to the bottom half, that's how we get to your weighted average cost of capital. And the question now is, well, let's compare this to your returns, and this will tell us if you're adding or destroying value. If your cost is less than your returns, you are adding value. If your cost is higher than returns, destroying value. And we're going to go through that specific calculation in the next video.